Welcome to the Final Bar, the show where we check out the most interesting charts to get set up for the following week. With some intermarket studies, we'll be finding out the inflection points for minimum risk and maximum reward. I'm Greg Schnell, and I have Zach Dillon, our producer, on board with me. Good afternoon, Zach. How are you today?
I'm doing good. How's it going with everybody? Well, it's just you right now, actually.
It's just me. Yeah, things are good, actually. A little busy. Put out a commodities countdown as well today, so there's lots of video going out today.
Yeah, keeping it nice and busy. I definitely know that we're keeping our video editor quite busy right now, as I'm actually moderating chat right now. Rebecca just commented, said, "Congrats on the new show, Greg." Which, by the way, let's go ahead and bring up that browser if you could.
Sure. Let me skip over there.
And we'll show everybody where you can go.
That
Apparently,
wasn't
to
the one.
kayak.
Yeah, no, that wasn't really the one I was expecting.
It's all right. And this is going to be where you guys can ask Greg questions, where you can give him comments. Go to that Stock Charts TV live tab at the top, and the Slido app will open up on the right-hand side. You can answer the poll that Greg has posted in there, and then you can also ask questions to Greg, which we will then be giving to him at the end of the show, so that if he has any time to answer any of those questions off. Other than that, Greg, it is your show. Go for it.
Okay. We have lots to cover today. The market has been a little bit one way. We've been heading up. I don't like that on my screen. Let me get the other version of of Safari. So one of the things that's happening a lot right here is we've had a lot of moves um, in the commodities, and I just want to show you the agenda briefly to show you what we want to cover off. Bonds really are at a crux point or a critical inflection point right here. I know we've been talking about that for a while, but there's some reasons why today really changed the tone, and so we want to cover that off a little bit. But the index clues are important here, and we're really getting poor performance from the semiconductors. Believe it or not, the banks were one of the better performers today, so that's a little bit helpful. But there's a poll on the right there that you could answer. And I think it's really a question of whether or not we can get some rallying in some of the more important sectors. The REITs are actually setting up, but the commodities have been roaring, and I'm not really sure if we're going to be able to get that to continue. And the main reason I'm worried about that is look at the big move the US dollar made today. It literally jumped out of the base here. So it was down near 2 week lows just a couple of days ago. And then today shot right up. And now it's headed back towards the top of the range. What makes that really hard is when we're heading towards the top of the range on these charts. Sorry, I lost my chart there. When we're heading towards the top of this range, it gets critical for us to understand what's going on. And one of the things that I like to watch for is bonds, currencies, equities, and commodities all trying to reverse at the same point in time. Now, it might not be on the same day, it might be on the same week or within a couple of weeks, but really want to be aware of that. So, one of the things that's going on today in the bonds was that they sold off quite hard. And what we need to watch for is that just a snap down, or is that actually going to make an island high on TLT, and something that we really have to worry about. So I'm going to cover off the currencies briefly because they're sitting in a very, very tight spot. And the PPO is already rolled over on the euro, suggesting the euro is going lower and the US dollar is going higher. If that was the case, that would be the big trend change we've been watching for. So this would be an 8-year trend line on the euro that would be breaking. And on the US dollar, we'd be breaking down from this breaking out from this consolidation zone. So those two things really give us a reason to be focused right here. And look at how tight this trend line is. And we're just sitting here right on this trend line, watching to see which way this is going to go. That's the Euro daily. I want to show the Japanese yen. And the reason for the Japanese yen is it broke a trend line. This is a short trend line that broke pretty much on the first of the year. But what you can see from this really big picture is this was a 6-year trend line, and it broke it January 1. Now it appears to have rallied up, and it just has this slow descent to it. Well, that's not major. One of the things is in the background, you can see gold, and gold has tracked the yen quite closely. So if we were looking for a reversal in commodities, one of the things we might see here is if the yen falls, this gold fails to break out of this area, and yen comes back to test this downward trend line. I don't know if that's going to happen, but look at how close the PPO on this weekly chart is to giving us a sell signal on the yen. So everything is lined up here, because if the yen was to start and turn higher up here, I think we'd see a huge acceleration in gold, and it would literally pop to the upside. So that would be a change for the commodities. And of course, we've already got the change in the yen here, but we're watching for the change in the euro. And I pointed out that US dollar chart earlier. Let me just go grab that. So on this bigger picture, this is the 2000 top, but on this bigger picture on the US dollar, this is the downtrend we're in. And what's happened is we started to make higher highs on momentum, and we're just grinding sideways here. So it's unknown which way we're going. You would still suggest we're in a bear market looking at this chart, but on the weekly chart, it looks much more suspicious that we're starting to enter a new turned up phase. So the PPO momentum has been broken, and we're actually heading higher here, even though this just continues to consolidate. So I'm watching very closely to see which way this breaks, because if we had currencies and commodities both starting to break, then we'd want to be looking at bonds. So let's go look at bonds. And the reason that I'm just going to go straight to TLT first so everybody can see what happened that's got me so sensitive. This is a 5-year picture, and you could see that we've built this big head and shoulders top on bonds, and everybody's talked about the bonds breaking down. This isn't for people to invest in the bonds, because this chart you can see only moved from 112 to 127, so $15 basically for 3 years. Hard to make any real money on that when you've got $100 invested. So it doesn't move very much. So we're not really talking about it for an investment. We're talking about it for a tool to watch the direction of the bond market. And zooming in here, what we have is, I might want to go in even tighter if I can. Let me just change that to be 2000 and maybe 12. Okay. Sure, that would be fine. So what we've got is this gap here, and then all of this kind of range trading area. And now we've just gapped all the way down below all of this. And you can see we're getting down close to the end. But look at, here's where the 200-day moving average comes in here. And so this was clearly just like let go, and we went right below the last 2 weeks of the range. Now, 2 weeks doesn't make a huge turn, but the problem is look at the MACD setup has already rolled over. And now if we roll this out, just let's pick a year or something like that. And you can either just type this in or you could drag the slider. I'm trying to control it a little faster than the slider. But you can see support and resistance right here. And we pretty much failed at resistance. We're below the 200-day moving average, and we spent a couple of weeks trying to get back through it and couldn't. So bond prices falling means yields rising. And the yield chart, of course, is up around 3%. So if yields were going to start climbing higher than the 3%, obviously that would be a big change for the market. If I go look at the, I just want to go grab one of these charts. So here's the 5-year as an example. And what we see on this 5-year chart is it's just going to the moon. So this is clearly breaking to the upside. And if we look at the 2-year, we all know that that's been moving higher aggressively. So this continues to shoot up. The next place we want to look is the 30-year. And the problem on the 30-year is this is a 30-year chart, and it's sitting right on this bottom edge. But look what happened today. Whenever I do that, it tries to break below this bottom level here. And if this was actually going to break down, so instead of bouncing like it has every other time on this 30-year trend, and now starts to break down, this would be a major change for the bond market, and it might be kind of the final cliff that we've been hearing so much about, that the bond market is is going to break down. So I've mentioned how close the euro is to breaking out, how the yen is already broken out. The US dollar looks like it's trying to turn up, not down. So that would be a trend change because it's been going down for about 18 months. And so 16 months. And from all of those things, we've got that sitting there, and we've got gold, which is sitting right at its trend line. And if it was, of course, going to break to the upside, then we'd want to notice that. Or if oil got to this $80 level and then rolled back over, sorry, $70 level and rolled back over, that would be another thing that would kind of confirm it for us. So we have all of these things lining up literally in the last couple of weeks here, pointing to a real major deal. But one of the things that looked just a couple of weeks ago, it looked like the 30-year price was going to turn higher again. And sure enough, it just ripped it straight back down and is now breaking below the previous low. Now, this is a weekly chart and this is not a Friday close, so we have to wait for tomorrow afternoon. But we really want to be set up for that. It doesn't like it when I'm in when I'm in Zoom to do my zooming in like I like to do. Okay, so with this, very critical point on the chart. And so the bonds really, really are concerning. I want to go back to the index clues and just work through a couple of those. And the way I want to do that is to, go directly to the S&P 500. And I'm just going to run up here. There are lots of things going on this chart that makes it pretty interesting right here. We are about to hit, tomorrow is our options expiration during earnings. I think it's one of the most important times to be aware of options periods, especially during the earnings call. So here we had options during the earnings, and it was just kind of 1 week before the highs. A Fed meeting was right here, and we fell down within 9 days. We're right at the next earnings period. So again, January, April, July, and October are the months where kind of earnings season is. And so the options expiration during those periods are pretty critical. So that is tomorrow. But one of the things you'll notice here is see how we have a lower high and a lower high on the S&P. Look at the structure we have setting up on the NASDAQ, which is a head and shoulders top. So if there was a place for us to fail, even if we rallied for a few days and just got back up to 7,000, which would be a pretty good rally, so an Amazon surprise or something big, some of the tech companies actually come out and give us a big boost here. We could go up to that 7,000 level. And if we rolled over anywhere in there with these lower highs in place on the S&P, I think it's pretty important for us to be constantly checking our work and making sure that we're aware of the trend. We can see a definite wedge structure in both of these. And usually the wedge structure, the way it works is it looks like a crane and there's a rope hanging down, and that happens to be the next bar. So I'm not expecting it to break down right now. It might have topped today, but I actually think there's some more tech earnings to come out in the next few weeks, and hopefully we'd get a rally into those. If we don't, I'd be very, very cautious here, because the problem is we had a big bullish day. Yesterday didn't get much price action, and then today, of course, we gave most of it back, but we're still in the middle of the bar. So on this big Mariposa candle, we'd like to see this break. We'd like to see this middle hold. We wouldn't want to go down and test the lower end of the range. That's very weak usually. So much like down in here, we had a big bar up, back down to the middle, and then we ran again. So we'd like to do the same thing from here. My big concern is this overhead resistance is really starting to build. So with the changes that I mentioned on the currencies and stuff, if the equity markets are actually marking a final right shoulder top here or something like that, all of these things would come into junction, coincidental timing where they're all hitting at the same time. And if the bond market was to crack here, I think that would be an important place to be aware of the trend change. So we really need to be heads up on that, because we don't have a lot of the markets are weak enough that if things started to sell off quickly, I think they'd move pretty quick. So the indexes are sitting right at a vulnerable place. The REITs chart, I'm not going to get into it a whole bunch, but the REITs are starting to set up for a turn up, which they haven't done for a long time. And maybe that's a move to safety while the indexes are breaking down. But with the few minutes we have left, I want to cover off the commodities. And the reason I want to cover them off specifically is because they, obviously, I do the commodities countdown, but if you look at the Dow Jones indexes today, this is for 1 week, and look at what it's been running. It's coal, aluminum, non-ferrous metals, industrial metals, basic resources, exploration and production, steel. Like, it is just commodity centric. It's very, very focused into the commodities. Now, all of that looks pretty good until I tell you that, you know, the US dollar all of a sudden started to rotate higher after being down near the bottom of the range. And it's been doing that for 3 months now, where it's literally ripping one way and then ripping the other way. So gold is back in the middle, pretty much the middle of its 2-week range. Nat gas is at the lower end of its range. The crude oil had moved all the way up and is testing that $70 level. I think it got up into the high 68s today. But if it's going to roll over right up here near this level, that would be another confirming point. So everything is so tightly structured, and I think we need to be very, very cautious that all of a sudden these big turns are taking place. One of the charts I like to look at a lot is the railroads, and the reason the railroads are so important, maybe I'll just go get my chart here. The railroads are a really good indicator of market direction. And so we saw back in 2014-15, when the railroads broke, the actual stock market topped in May. So let's just pick about here. So as this railroad broke through the upsloping trend line and came back to test it, that's pretty much when the market topped out. Here we have the railroads briefly broke down. Now they're coming back up, but they're checking this triple top. And if we could get the railroads to keep going, that would be a very important thing for me. And if the railroads start to stall here, I'd be much more worried. And you could see back in 2014 and 15, over a period of 4 or 5 months, we kept checking this top and weren't able to take it out. And then it became a pretty dramatic slide. So here we are checking out the top, and I want to see that hold a lot. If the railroads can keep going, I think they're more important than anything else. Now, trucking is obviously important, but just the overall picture on transports, which we like to use as kind of a macro against the industrial sector. So when the transports are doing well and the industrials are doing well, it's very bullish. But the trend we have here is that the 50-day moving average is holding all of the transports back. So that would be trucking, rail, and air is being held down by this. So, we're at this point where these two lines are not very far apart. And if we were going to start breaking down on the transports from this huge 2-year trend, I don't think that's something that we should ignore. So that's how many things are just sitting on the edge here that make it particularly concerning. And in the industrial case, what we see here is, so we had big, huge trends, 13, 14. When the trend lines broke in, a little later in 2015, what we saw was they rolled down and then made kind of a 3-wave down, and now they've taken off. Here's the problem. They've now broken below that previous trend line, and we're back testing it from below, and we're also right at the 10-week moving average. So if everything was to fall apart here, this would look very reminiscent of the same thing we saw back in 2015. So the timing is all set up for us. The problem is, if we bounce from here, that's the bullish scenario, but it's literally at the last point of control. And then any sort of breakdown here would be more bearish. So I'm much more focused on trying to figure out which way the market is trying to go through all of these different indexes than the trying to follow just the S&P 500. I think we want to look around and just kind of keep track of what's going on. The one positive piece of news today was that the best performing sector was the US banking index, and it was up 2%. And let's just click in on that chart. And the reason I want to do that is it's actually making a higher low in momentum as it made, pretty much the same low in price. So I'm happy to see that, and a bounce out of here would be quite bullish. If we look at this downsloping trend line across these three peaks, what we see there is a potential break to the upside on the banks, and maybe that gives us our final rally, or at least a rally to get things started, and then we'll see if the market has enough energy to get through the options expiration tomorrow, the end of the earnings season around the end of the month, and the Fed meeting at the beginning of May. So with all of that, we've got things really set up quite tight on a platform here for us to be very, very cautious. I do have just a couple more charts that are interesting. Let me just go grab them. This XLI chart, zoomed out, it doesn't look like much, but look at how good a clue we got from breaking the upsloping momentum trend for 2 years and when it broke. And over here, we had the upsloping momentum break, and it gave us some time for this trade to happen, but it ended up being pretty much a false signal. But we did have, this volatility looks like no big deal, but it was actually, quite horrific. And in October 2014, lots of people were very, very worried. And of course, that's when the oil breakdown was happening. We broke through support, dipped below, and then took back off to the upside, and didn't make much more headway. So it was almost all in this one couple of maybe 2 weeks that we ran up, and then everything just went sideways. I think if the industrials are starting to tell us this story, and the rails are sitting so finely tuned against that upside resistance, all of that adds up to me that we should be watching very, very closely. If commodities start to reverse here, like oil started to fall, I think that these dominoes would start to quickly click in, especially with the recent weakness on the banks. So I'm hoping the banks can extend this and get us some rally in the S&P 500. But that being said, these charts are all set up for inflection. Lastly, just with a couple of minutes, and then we'll open it up for questions, I just want to show the bullish percent indexes on the NASDAQ and on the S&P 500. And what we see here, this is for the NASDAQ 100. This was a major bounce level, and we're up around 55%. We really want to see it get all the way back up to this 70 or 80% again very quickly, because the only other time we've really seen it kind of languish down below was back in 2008, where it couldn't really get going again, and then it just started to falter. So we do not want the market to roll over while there is so little energy in it. And it doesn't make it the new 2008. It just means that, typically we had the market had quite a rough period through there, and it was many, many months later that we actually started to break down hard. But we don't want to see it falter this much that we start to lose momentum so soon after rebounding off a deep low. And lastly, I'll just get the S&P 500, and we'll open it up for questions with Zach, so please send them in. We have the bullish percent index bouncing off the 40 level. This is a very good place going historically on the chart. But once again, we want to see it get all the way back up to the 65 or 70% level, because when it languishes down a little bit lower here, we can go through some pretty rough patches in the market. So a bounce that doesn't get back up into kind of full blossom, if you will, is a problem signal for us. And we're at the point now where we should start to see acceleration. And if we don't get that acceleration, then we could probably have another big weave lower in the overall indexes. So with that, Zach, I'll just check in and see if there's any questions.
Yeah, so we have Stella, who has a couple of votes. It looks like only one vote, so that's two people who wanted to know if the U.S. dollar will go up, what about the oil price, besides the supply and demand relationship?
Yeah, I didn't show the bullish percent for energy, but it's on the XLE chart, so let me just go grab that. The XLE is sitting right up here. And one of the things that you'll notice is whenever the XLE goes on this sudden spurt, it usually just consolidates for a while. And I feel like we've already had the move, the sudden spurt in energy. I mean, this is quite a dramatic move in a week. And so, maybe we drift a little bit higher, but for the most part, we're at this major resistance level on XLE. Now, if we go to XOP, which is exploration and production instead, this chart sitting right at this 40 level, I'd call that pretty strong resistance. So we're sitting here watching to see if the stocks can get through this level, but look at how many times it's been support and resistance. All of these areas suggest to me that we need to at least pause with energy. So, I own a lot of it. I don't want to sell it, but it might be time to either lighten the positions or put some options to help protect it, that kind of thing. So I think energy, as much as I like the move and I want to see more of it, I feel like it needs to consolidate for a bit if it's still going to go higher.
Awesome. And then we have, it looks like Larry with a couple of votes. He is asking, can you talk about silver, SLV?
Whew, silver is a really good one, and I would encourage you to go check out the commodity countdown that I just posted, and it's called Bonds Buckle is the name of the video title today, but it's on the Vimeo channel, so vimeo.com/channels/Greg Schnell, and you'll find it there. I think we've seen this move in silver before, where they gap right up and they have these huge surges, and they're literally like needles in the sky, and they just roll right back over, and we're right at that trend line. So I don't want to say that it's over, but I do want to say some of the silver shares I had today, I took off, and the only reason was because they had just had stunning moves in a week. This is a bullish setup typically, and we'd like to see it break out from here. I think the real question is, can we get the US dollar to break down? And, the price action today almost mimicked exactly the problem we've had, is every time these things start to surge, so does the US dollar, and they end up reverting back to base. So the silver chart is really, I'll call it finely tuned, and obviously a breakout here, extremely bullish. But until we get that breakout, big caution, especially if the US dollar wants to push to new highs, or at least break out of the range to the high side.
And it looks like we only have about 1 more minute, so maybe one more question. I'm going to try and consolidate 2 of the questions. They're talking about lumber. Do you have any thoughts on lumber, and in particular WY?
Lumber just keeps flying. So it's up in the top right-hand corner of the chart, much like this Weyerhaeuser chart. And, this price action up here is very good. OSB is another chart, which is Norboard, just broke out to highs. I just think everything feels stretched here on the lumber side and needs to pull back a bit. But, Canfor Forest Products in Canada, this is also a really strong chart. So looking at all of these charts, they're up against, a lot of them are checking double tops. So if they roll over, that's a big deal. The ETF wood is also another way to check it out. But they just look extended, nothing wrong with that. I would be cautious just if the overall market rolls over. These checked back in February too. So if the market was going to give us a little more headaches here, they'd probably pull back as well.
Cool. That should be about it. Might want to look at wrapping it up for today.
Sure, I'll do that. Okay, so first of all, I want to thank everybody who's taken the time to sign in for the first edition of the new show. We are. I just want to use the show to kind of find the best spots in the market for us, and hopefully that'll work out for you as well. So I want to thank you for joining us on today's show. The Final Bar airs live on Thursdays at 5 p.m. Eastern Time and can be found on the Stock Charts TV schedule for your viewing convenience at other times during the week. It is also available on the Stock Charts YouTube channel. With that, feel free to comment on the show in the survey box below. And with that, have a great weekend and good trading.